Hello everyone. Today we discuss about the base rate as a basic concept briefly. Let's start with a few words about the central bank and its role, and then look at what the base rate is. Since 1987, there has been a two-tier banking system in Hungary. This means that there are normal, commercial banks where you can open an account yourself, take a loan, invest or use another service, either as an individual or as a business. And there is a bank that is in control of the whole system, responsible for the stability of the financial system, and with which the commercial banks keep their accounts. This bank is the central bank. Although it maintains bank accounts, you cannot contact them directly, neither as an individual nor as a business. Their responsibilities are completely different. This is regulated by a law. The central bank's responsibilities include managing reserves, be it currency, gold, or any other asset. It also has the task of providing cash in the economy. This can be done either by printing money or even by lending. However, its task is also to ensure price stability, and one of the tools for this is to change the base rate. And here we came to the base rate. Let's see what this concept means. The base rate is part of the monetary policy toolbox. This is nothing more than a key interest rate applied to commercial banks for their accounts. Let's look at how the level of the base rate affects the economy. One of the tasks of the central bank is to maintain inflation targets. Thereby, they ensure that it is neither too slow, which can lead to deflation, nor spin-over, which in turn can lead to hyperinflation. This goal can most easily be achieved by regulating the amount of money present in the economy. Now let's ignore the possibility of printing money and stay with just the effect of the base rate. One of the basic observations of the economy is that the more abundant something is available, the lower its value. The more scarce the availability of a particular thing, the more valuable it is. It's no different about money either. If money is readily available, say because interest rates are favorable, thus, it is easier for both the bank and the borrower to say yes, then the amount of money in the economy will increase. Obviously, this is also being spent, which could boost the economy. This brings with inflation, given that the ever-increasing amount of cash will be worth less and less. However, after the credit crisis of 2008, it was necessary to continuously reduce the base rate in order to start the engine of the economy as soon as possible. This also increased inflation, a general and lasting rise in prices. In this regard, I recommend to you a video on inflation, which you can access here. Now that life has resumed after the closures due to COVID, people started spending, and because of this the inflation rate exceeded the limit, which the central bank deems no longer healthy, so it is necessary to slow down a bit. This break was the interest rate hike, which has an impact on the economy both on the credit side and on the investment side. Let's first look at the impact of a change in interest rates on the credit side. Variable interest rate foreign loans are usually priced at the level of BUBOR. This is the Budapest Interbank Foreign Loan Interest Rate. If I want to summarize briefly, that is the average cost to banks of financing a loan to you. As banks can obtain significant funds either from each other or from the central bank, the base rate also affects the level of BUBOR. If you look at the two pictures, you can see that the banks also get the necessary funds at a price roughly equal to the level of the base rate, which will also be reflected in interest on loans. Of course, this is not only true here, and not only in the case of foreign loans. The same processes take place in every country. An increase in the base rate will lead to an increase in lending rates. This also applies to newly borrowed loans, as well as to floating rate loans, the interest period of which will be termed until the maturity of the loan. If you have a loan that is already running but has a fixed interest rate, the central bank's interest rate changes will not affect your loan at all. In the description you will find a link to calculate how much extra cost the interest change will cost you. For a variable rate loan, you can ask the bank to set a fixed interest rate on your loan. While this is expected to have some cost, it is generally lower than the total extra amount paid as a result of the interest rate hike. If you have an old loan that is still running at a relatively high interest rate, it may also be a viable option to refinance it. Then a whole new loan will be launched to the current, still relatively low interest rate. Obviously, you can apply for a long interest period or with a completely fixed interest rate. When you think about what your next step should be, don't just calculate the current, a few tenths of a % increase. After all, it's not you who decides on the base rate, so you won't be able to predict how much that level will go up. The change in the base rate also affects corporate loans. When a company decides whether to make an investment, it makes a decision based on a comparison of expected benefits and costs. Of course, using a loan is not a problem for a company, it can even have a positive effect. An investment made from a well-thought-out loan will stably extract the cost of the loan and even remain so. If the company chooses a loan, the average cost of capital will increase along with the increase in the base rate. This reduces the profitability of the investment. This is why there may be projects that are not being implemented now. This in itself cools the economic spin, but if you bought shares in a company that decided it could affect its subsequent management, as well as its ability to pay dividends or its price. And with that, we got to the investment side. For investments, let's look specifically at the impact of the interest rate hike. The interest rate cut will have the same effect, only with the opposite sign. Before you ask why you don't always experience what you're going to hear right now, the answer is simple. What I am saying now is purely the effect of a change in interest rates, but real life is more complex than that. Most often, the inflationary effect also appears as a kind of counterforce. That is, if a base rate hike curbs high inflation, it will have an impact on almost all assets in the short run, but due to low inflation, everything will calm down relatively quickly, thus weakening each other's impact. Now let's look clearly at the effect of a change in the base rate. The level of the base rate has an impact on the return on long-term government securities as a risk-free form of investment, and through that on everything else. Government securities that already issued were priced at the existing interest rate level. The market will reprice due to the interest rate hike, and since only the new interest rate has risen, but not the interest on the old paper, this is expected to result in an increase in yields. Don't be fooled. If a rise in yields is mentioned anywhere, it means a fall in the exchange rate. This has already been discussed in more detail in the video on the relationship between interest and yield. You can access the video here. Since you get the extra return for the extra risk you take, the risk has not changed, only the available return, so the price of the shares may also fall. If I want to put it a little deeper, I can say that risk also includes when and how much money will come back from your investment. It is not enough for comparability that 100 forints come from it every year. To make a decision, you also need to know how much these cash flows are worth at a given time. You can compare two investments with a present value calculation. You can reach the link to the video about it here. As the base rate increased, so did the discount rate, so the present value of an amount paid in the future will decrease compared to the previous calculation. And this can lead to a fall in exchange rates. It is obvious that the further away the cash inflow from an investment is from the present moment, the more negatively the interest rate increase affects the exchange rate. This is why interest rate hikes will have the most negative impact on growth stocks, as you'll see money from them for the most part sometime in the distant future.